Hi guys, welcome to the channel. My name's Adam. This is Invest 2140. Recently I've been asked by a few people, family and friends, why we should be investing. So I thought I'd make a quick video about it and cover some bits and pieces that I think are interesting as to why you might want to invest in stocks, trades, options, bonds, etc. So without further ado, let's get into it. Obviously, none of this is financial advice. Just to go on the internet, so always do your own research and look after your own money, investments and trades. Do hit the like, subscribe and notifications buttons for me, please. It's always good to help the channel. The further we grow, the more we can do. So the first slide we're going to look at is the analogy of the fiat of melting ice cubes. So what is fiat? Fiat is the currency that we use. So if you live in the UK like I do, then fiat would be the Great British Pound. In the United States, you're going to be using the USD and so forth. And why do we call it the melting ice cubes analogy? Basically, everything that we hold in that fiat currency, such as Great British Pounds, whether it be my property or whether it be my savings or anything like that, every year and every 4-year cycle, as the government prints more money, we are slowly being debased, and everything that we own in that fiat, in that Great British Pound, is slowly being wilted away as such, because it's being diluted. The more money that they print, the more that's out there in circulation, the less whatever we hold in assets in that currency is worth. So Keynesian economics, it advocates the government intervention to stabilise economies through fiscal stimulation, such as quantitative easing that you might have heard over the times, liquidity, there's something called M2 money printing, M2 value, and money printing that governments do. And basically what this is doing is every time there's a recession, the government will obviously increase the liquidity, therefore print more money to put into the economy to get us out of a recession, which is fantastic short term, but long term it has detrimental effects on everything that we own asset wise, like I say about this melting ice cubes analogy. So basically everything that we own in Great British Pounds is being debased every time they print money. Ever since the great financial crash in 2008, our governments and all major economies around the world that use their Keynesian economics basically will go through cycles of liquidity, and it coincides roughly every 4 years. Coincides also with the Bitcoin cycle as well, which is quite ironic, but we'll look at that a little bit more in detail later on. But basically real life wealth is being eroded away if investments aren't making probably 10 to 14% annually. The reason I say that 10 to 14%, you get some real hardcore people that believe true inflation to be much higher, and then obviously we all know that inflation is based on GDP. So like I say, for me, what with the global M2 value, government printing money, debasement of real life assets, if you're not making 10 to 14% on your assets or savings, you're actually getting poorer each year. Me personally, I've been on the same income for the same steady wage salary for the last 6 or 7 years, and prior to that I was always on commission based stuff, and with the peaks and troughs you don't really notice as much, but because I've been on the same salary for the last 6-7 years, I have definitely noticed real life wealth being eroded away, which made me look into other options. What can we do to get more out of our investments and make money work for us? So that's what this video is all about. This is what I've been speaking to my friends and family for some time now. And so without further ado, let's get a bit further into it. There's another famous saying that fiat is going to zero. So the Great British Pound, the US dollars, the more they print, the more it erodes and debases everything, and it will get to a point where it's beyond saving. And this is what the big push out in the United States is at the moment. They realise that their debt level is it's surpassed their defence budget, which is huge. So they're now paying more in debt fees than what they are on their actual defence, which is incredible. So obviously what they're trying to do is they're trying to rein it in a bit, cut the spending and the waste, and so what affects the quality of our fiat? So we talk about this big red button when it's being pushed, when the government step in and print more money to try and save the day. So things that can affect that, such as the cost of living crisis, obesity problems, wealth inequality, deterioration of family units, homelessness, swollen governments, loss of trust, chronic health issues, political instability, addiction crises, declining birth rates, social instabilities, mental health crises, and forever wars. Another analogy is that nothing stops this train, i.e. once they've started printing the money, every time there is a problem, they will print more money to obviously throw money at the issue to try and resolve it. When I have done previous videos, we talk about where we might want to invest, and for me the United States stock market has been the best over the last 2 decades probably. Unfortunately, the FTSE 100 and the UK stock market just hasn't really been worth investing in. So for me, I always look to the US dollars and the American stock market. They have a fantastic analogy that they use that's called the cleanest shirt in the dirty laundry, i.e. the US dollar against other countries' global currencies is probably the best out there for being, the least debased. If we look on this list here, you can see there's a number of other countries, major G20 countries, so Turkish lira, for example, the Russian ruble. Russian ruble's at 66% debasement in comparison to the 10-year US dollar. Where are we on there? 1 second. Great British Pound. Yeah, we are 24.8%. So again, our currency, our fiat, our Great British Pound has been debased 24.8% more than the US dollar over the last 10 years. So again, if you're putting your money into US stock markets, which I think have been the best performing, what you're doing with that money at the end of the day, if you're just keeping it into a savings account, then it's slowly being eroded away. That's why we like to invest it, to try and get capital, try and make a lot more return on our gains on our capitals, to try and beat that 10 to 14% every year. Again, why do we invest in the US stock market? So this one here, we're going to look at the US, UK, German and French equities markets. So since 1872 to 2023, I found this slide that's quite a good representation of why we go with the US stock market. We can see at the bottom we've got the French, and then stepping one up we've got the German stock market, then we've got the United Kingdom, and then we've got the US. So basically it's the best performing stock market, which is why we want to be putting our money into that sector. Read a book by Robert Kiyosaki, who basically, the book was called Rich Dad Poor Dad, and it creates a thesis and mindset of, it talks about having 2 different fathers, obviously one biological, but one father who had a very good education, was brought up to study hard, work hard, get a good job, save, earn your pension, and then you'll be looked after your life. Didn't work out too well for him that way. And the other one didn't really get much of an education at all, but just took a real interest into the business side of things, and was a bit of not a wheeler dealer, but rather than saying, we can't afford things like this, we can't afford that, he would always say, okay, if we want these things, what can we do to achieve them? Let's put in a plan to work towards achieving it. So 3 major points that I really drew from the book that are quite important, and then I'll definitely be passing on to my children, my kids, are mindset and education. So the difference between traditional education, which teaches how we work for money, and the financial education, which teaches you how to make money work for you. So again, for me, when I was younger, trying to buy flash cars, nice clothes, all this sort of jazz, if I had have been told a few more things about how to make money work for me, I would have made much smarter investments when I was younger. Realising what the difference between an asset and a liability is. Again, asset is something that puts money into your accounts, whereas a liability is whatever you spend money on until it goes out of your accounts. So again, properties, for example, until the day that my property is fully paid off, it is a liability. If I miss too many payments, it will be repossessed and it's gone, and I've spent 20, 30 years paying off something that I no longer own. So again, just understand the difference between assets and liabilities. One of the core teachings is understanding the difference between those. Okay, so again, if you get a chance to read the book, I highly recommend it. And then financial independence, the narrative that pushes for financial independence through passive income rather than relying solely on paycheck to paycheck. So trying to get you out of that rat race. If you want a nice new fancy car, buy some assets that will make you cash rich in a way that will generate enough wealth that will pay for the car, and then the car's free. Yeah, rather than getting a loan out and working each week, each month to pay the loan back for the car that you wanted. All right, just trying to work that one round. Another one that we talk about is fastest horses. So I've bought and sold a few properties over the years, and one of my bugbears with the property market and things like that is, yes, it's a slow burner, and yes, over the 25 years, however long you base your mortgage over, at the end of it, you've got a fantastic asset that is generating you cash, which is obviously what you want for your retirement, super duper. But during that time, during that 25 years, my problem is you're going to be spending, especially on the initial purchase of the properties, you're spending a lot of money, stamp duty, legal fees, if you're doing renovation works, all this sort of stuff, you're paying out a big lump sum, 20, 30, 40, 50,000 pounds, depending on how much your property's worth, and your stamp duty fees and solicitors fees and all sorts. You're paying a lot of your capital out that is actually not being used or not going into that investment itself. It's just being paid to other professionals. So what if you could get that capital, get that lump sum, and then incorporate your initial and pending and future investments into the stock market? And like I say, the average savings account as well, giving you 4 to 5% APR, is obviously, because we know the debasement and everything else, if you're not making 10 to 14%, you're just getting poorer every year. And again, looking at the property yield for this example, over the last 10 years, on average, properties have gone up 51.8%. And that's just 10 years. So the yield returns roughly 5.2% average. So again, properties, unless you get a super bumper year or two, one of my properties, I remember when we bought it, stayed there for 3 years, and it made £100,000 in the 3 years, which is incredible. But since then, that's never happened again. So yes, you can sometimes hit a really sweet spot in the property market where it will have a huge gains period, but on average you're looking at 5 to 6% returns, which is a bit more than the savings account at the moment. But again, you're paying a lot of money out up front for other professionals and services and searches and whatnot that I think would be better invested into stock markets and whatnot. Trading options. So when I speak to people and I talk to them about the different options for trading and the potential gains associated with each option, this is the list that I spoke to them about, and really we only looked into 2 or 3 of them and a bit more in depth into maybe 1 or 2 of them. I didn't want to bore them all to death, but the main point is certain stocks such as Tesla, Meta, MicroStrategy, they can all be purchased and traded on Trading 212. Really easy app, really simple to use. And if you're getting off and starting trading, that is what I would definitely recommend using. You've got other ones such as Robinhood that are very similar, GUI interface wise. The user functionalities are very simple to follow, and they do test you. They do, before you open anything up, they will ask you a series of questions to kind of gauge your level of understanding of stock markets and indices and forex, ETS, bonds, etc. And then they'll guide you through a few bits and pieces. So we looked at stocks, and then we looked at indices such as the S&P 500, the NASDAQ, so the QQQ. And again, you can also purchase them through the Trading 212 app. Then we spoke briefly about currency trading, etc. I don't do that myself, so I didn't give any advice on that at all because I'm not exposed to it. So, but it is something you can learn out there. Then ETFs, so exchange traded funds such as IBIT, VUSA, VUAG. Again, all of those are available on the Trading 212 app. Then we spoke a bit about bonds, the 5, 10, 20-year bonds, yield when they're rolling over, good ones to get into, such as, say, TLT. And then the applications that you can trade them on. such as Saxo, for example, and then options. So longs, calls, and leaps, and how you might want to look into that as well with regards to leverage plays. But then the dangers and hazards associated with playing with longs, leaps, calls, and leverage plays. And then the last one that we looked into, which is obviously really in all the main news at the moment, has been over the last 6 months, is the crypto market. Again, very you can make huge gains on it, but you need to be very clued up on the market, on the ball, monitoring your investments with crypto, because it's very volatile. So for me, Bitcoin, Solana, things like that are the major ones that we were looking into. Obviously, I've explained to him about the stable coins, and I've explained to him about the meme coins, and then where you can purchase all this sort of stuff on Coinbase, Kraken, etc. Then you've got the DeFi's, the DEXs, so decentralized finances, DEXs, so decentralized exchanges, DePINs, and then staking. So we looked at the S&P 500 just as a safe. When we talk about allocation for your portfolio, one of the questions that come up was, what's a safe? So the people that I spoke to a couple of weeks back, as a multitude of different people, multitude of different ages, and multitude of different jobs. So the risk profiling for each of them was very individual, very different. Time horizons was very different. One was a retiree, one was relatively young and had only ever stepped into the properties. So everyone's time horizons were different. Everyone's risk profiles were different. So we looked at a varied portfolio that they might want to look at. So S&P 500 returns. So if you invest in the S&P 500, again, market data for 96 years up until December 2023 via the Capital Group. I pulled this one off because it shows that the longer that you are invested into the S&P 500, the larger your percentage chance of probable success. So if you just invest in the S&P 500 for 1 year, there's a 73% chance that that's going to be a successful year. Okay, now what do we class as successful? Basically, you're making gains. Again, we'll talk about what gains might be associated with the S&P 500 a little bit further on, but let's look at the 3 year. It increased to 79%. If you stay into it for 5 years, it's up to 88%, and if you stick in for the full 10 years, for example, then you're looking at 94% probability of success. Now, the bull and bear years, again, trying to explain some difference between bulls and bears and the macro to micro effects. So bull markets, obviously, when stock markets are going up, and bears are basically when they're retraining back. So if we look here, you can see in 1993 there was a bull, then 1995 bear, 94 there was a bear, then 95 we had 5 bulls in a row, then 3 bears, then 4 bulls, then 2 bears, and then from 2009 all the way up to around about 2022, a long bull cycle. Okay, that's very rare. Normally you get say 4 or 5 bulls to one bear. So again, why is that important? You need to understand trends. You need to be listening to the right people to gauge the market. The worst time to enter the market, and this is what I was trying to explain to them, that you've got different entry points as well. You can do lump sum investing, which is, if you time it right and you hit a positive on the very next day, following week, month, whatever it is, you see a huge gain, and it's fantastic. Makes you feel very good. The bad side of this is that if you time it wrong and you enter, and the very next day something goes wrong, there's a huge global macro issue, there's another war kicks off, there's a shortage on one commodity or the other, then all of a sudden you can have a big downside, and that big downside risk could be 15-20%, depends on what your investment portfolio looks like, especially if you're in crypto. And given the last 2 weeks of the crypto, it's been hit hard. Bitcoin's been down 20-25%. Meme coins and less known coins down 50, 60, 70%. So again, if you did your lump sum investment and then you lose 60, 70%, you're going to be crying. It's going to take you a long time to recover that. Whereas if you DCA, so dollar cost average, if you say, right, I've got $30,000 and I'm going to put $5,000 every month in, you will average out your peaks and troughs in a much more stable way. Okay. So of the S&P 500, obviously it's made up of the top 500 companies in the United States. Now, what I wanted to get across to them was that of late, out of those 493 companies, not all of them have really been doing that well. But the Magnificent Seven, Google, Tesla, Nvidia, Meta, Apple, Amazon, Microsoft, of those Magnificent Seven, and then if you class the eighth one, MicroStrategy, they have really had the biggest gains. So rather than maybe playing it safe, this is, again, talking about risk profiles, play it safe, stick with the S&P 500. And the S&P 500 might make average gains between 8 to 15%. Of the last couple of years, I think it's been around more about the 20% mark, which is obviously, beating your 10 to 14% of debasement level. So yeah, that way you're actually getting richer each year, slightly, but not much. What they might want to think about doing is, instead of just going with the S&P 500, maybe if you're going to put 50% of that into the S&P 500, split that 50% 7 ways, and then invest that 7th into each one of these businesses. You're going to get much more gains. So again, that's just another tactic that they could do. The Mag 7 makes the S&P 500 basically. So here we can see that the Mag 7 brought in 70% of the S&P 500's gains, as opposed to 24% for the rest of the 493 companies. So just proves that point. Now, whether that carries on, who knows? No one's got the crystal ball. But you look at previous trading years, and you look at what's going to give you the best returns. That is a bit of an obvious one for me. Something we spoke about earlier, and we did touch on, and I really wanted to drum it home, that when you're starting your trading, just for clarity, I've been trading for about 5 or 6 years, properly for the last 2 years. I say properly because 5 or 6 years ago I was playing around with it, didn't really know too much what I was doing, learned a few bits, stepped away for a bit, left some things, didn't really get into it, missed the 5 or 6 years ago the bull run for Bitcoin, 4-year cycle back then, but obviously much more heavily invested in this one round. But one thing I didn't realise last time that I really do now is about ETFs and leverage fees. So we're looking here about your portfolio value, for example. So over the course of 30 years, your portfolio value of £100,000, for example, depending on the costs of your fees and the percentages that you're paying, can have a huge difference on your final value of that portfolio. So whenever you're looking at ETFs, whenever you're looking at leverage funds, leverage plays, always read and look into what fees you're going to be paying. Because the difference can be, if we look here, your difference can be almost 250,000 in fees, okay, over the course of 30 years. So if you're a real, I say lazy investor, if you're like most investors and you just put medium profile for risk and you just put your money in each month after month, and they've put you in something that's got quite high fees and high charges, then you're not making yourself as rich as what you could be. So again, take the time, learn about the difference between the fees between one fund and another and leverages, and then you'll make a much better decision on what to do. For myself, again, talking about portfolio diversifications and the reasons and whatnot, and DCAing. So you can see I've got Tesla roughly around about 20%, and my MSTR bag at the moment is around about 17%. I'm running 38% Sol, and then I've got some Radium, I've got some Zeus, I do some Sol perping as well, which is interesting, dangerous, but be careful. Again, I'll do a separate video on the Sol perps. I've got 3 times Tesla because it's had a huge drop, so I've jumped into that. Again, leverage play, so don't really want to be in it for much more than 30 days, 40 days at most. But when there's been a big drop in something, sometimes it's good to play the leverage, as long as you've got a real driver, laser focus that is going to be going up. And then Neptune Digital and ArcG. So we got onto cryptocurrencies and we got onto hard assets, and we were talking about what is the hardest asset and what makes perfect money. So I was explaining that I believe the Bitcoin is the hardest asset out there. But why is it the perfect money, and why do I believe so? Because of the scarcity. It's a fixed supply forever. There's only ever going to be 21.8 million Bitcoin ever made. And funny enough, the last year of the final Bitcoin that we made will be 2140, hence the channel. So scarcity, and it's instantly and costlessly very viable. Okay. It's portable. Okay. So it's effortless to store and move. Divisible, so it's infinitely divisible. So remember, in every one Bitcoin there's 100 million satoshis. It's durable, so it exists forever without deterioration. It's fungible. Every piece is forever the same as every other piece. Okay. It's acceptable. Everyone anywhere can send and receive it, and it's censorship resistant. So again, it's very important. You hold it. Nobody else can take it away from you or stop you from spending it or sending it. What does that mean? How is that important? So say you bought a shit ton of gold, okay, however much. You want it to be really safe. You want it to, the market's going to crash, or you know that there's a bear coming, and bear market obviously, and you're thinking, how can I put my money to a safe store of value? You put your money into gold, brilliant. Okay, you bought a load of gold. Say for example, you wanted to emigrate, move abroad. There might be some questions asked about trying to take a huge amount of gold away with you. It's very heavy. It's hard to move. There's going to be questions asked. They might not let you. Like, you can only take £10,000 out of the UK in any one go. But with Bitcoin, for example, once it's held, take it off the exchanges, obviously, because never keep your Bitcoin on exchanges, especially given what's just happened to Bybit. Then basically with your seed phrase, just 12 magic word phrases, you can go and move abroad, go wherever you need to go, and then pull your Bitcoin out in another country. Very simple, very, very easy to do. So CAGR, what is CAGR? Compounded annual growth rate. So when we looked at many different investment opportunities, countries, treasuries, things like that, I wanted to show them why I believe Bitcoin is probably the best asset out there at the moment. I say at the moment, it has been for since 2008. But if we look here, you can see the gold 10-year compounded annual growth rate is 1.97%. S&P has been 11.22. Nasdaq 16 again, so a bit riskier, gives you better returns. And then you've got long dated US Treasuries, roughly 4.58. Tesla, again, a very volatile asset, but there you go. 63.8%, Amazon 33.5%, and then Bitcoin 196.72%. So it is, for CAGR, it's pretty impressive. So hence why I'm quite heavily invested into Bitcoin related assets. Then it brought me on to the cycles. So understanding the Bitcoin cycle, the 4-year halving events, what happens, when is it good to be in it and when is it not to be good in it. If you can time it right, then it can be incredibly profitable. But those that decide to just holding on for dear life, okay, those that just buy Bitcoin, put it away, don't look at it, aren't bothered about it, and will just look at it in 10 years' time. There is an argument that is the best method for gaining profits, because it is so hard to time the top and bottom of this. Everyone's got their theories and everyone's got their theses about how to time those tops and bottoms. But one thing is knowing about it and understanding it. Another thing is actually performing and making that to fruition. So again, we can see here that you've got 3 positive years, 1 bear year, 3 positive years, 1 bear years, 3 positive years, 1 bear years. So we are obviously past the halving cycle this time around at the moment. We have had the typical, say 4, 5x, 6x, something like that, from $15,000, what it was, go back a year or so ago. Currently, it's been recently around about the 90s thousands. I think it's just it dropped down to 78 yesterday or the day before, but it's back up to 86, I think at the moment, $86,000. So it's seen a huge jump already, but it is still, in my opinion, got a long way to go. We've got so many more US treasuries and states coming into Bitcoin that are trying to assign Bitcoin treasuries. I don't think the cycle's over at all. And you can see here there's always big drawbacks in between every bull period rather. So I think that the drawback that we've seen of roughly 20-25% is absolutely normal for the bull runs. So I think we've still got quite a way to go through this, probably another 3 to 12 months potentially. Obviously we've seen a lot of ETFs come into the Bitcoin bull year so far, and I still believe they will. MicroStrategy alone is pretty much eating every 2 times the daily allocation of Bitcoin with his purchases week in, week out. So yep, Bitcoin 4-year cycle again. So we could be roughly, say, maybe 50, 60, 70% of the way through the cycle. Is there still more? Obviously, my opinion is yes, a great deal more, in fact. Again, 32 states. This was probably a week or 2 ago, so there's probably more now that sign up to the Bitcoins. And not only that, but also what is going to create that banana zone for the Bitcoin. So what can make it go parabolic as such? So we're looking here at the Bitcoin price over year, and then so we're roughly around about mid cycle of the 100k mark. All right, so it's gone up a nice curve. Okay, so 4 or 5 times from where it was down at 15,000. We've had a 4 or 5x. And 6x, and then it's slowing down a bit, but I still believe that there is going to be a banana zone. So and that might be it could be liquidity cycle that we're just about to enter again, so that's going to help and push the price up. It could be that whenever there's another war, people want to put their money into hard, safe assets and take the money out of fiat, or it could be that more and more people realise that fiat's going to zero. So, and again, what's going to happen the day that fiat dies? Where are you going to put your money? You're going to look for something that is easily movable, isn't owned by one person, government or state or country, continent. You can't stop Bitcoin. So that's why we Bitcoin. So this then brought me onto this slide with the guys and girls that we were talking to the other week, where we said, okay, for example, if you were to put in a £30,000 initial investment back in 2023 into these are my main 4 assets that I believe in for the next 10-year cycles, where would the forecasted price assets be? So we looked at Solana, Bitcoin, MSTR and Tesla. So from 2023 to 2024, a $30,000 investment. We'll show you the splits in a second in the next slide. But this one here, we can see the price from 2023 to 2024 of Solana at the time of doing this was back at around about $240. Solana's now gone down a hell of a lot. It's down roughly around about 140. Bitcoin was 95. That's obviously dropped down a little bit. That was at 78. Go back 3 or 4 days. MSTR 377, that again is at the moment is about 260, and Tesla when we did this was back at 330. So we can see the prices of those at the 2024 mark. And then 2025, you can see slight increases again. Towards the end of the year, we're expecting Solana to be, again, a lot of these are sandbag, lowballed, but yeah, Solana to be around 311, and Bitcoin 119, MSTR 509, Tesla 430, 2026, 27, 28. You can see the years as we go out. Okay, now let's look at what that initial £30,000 investment that you might end up paying. The reason I picked 30,000 was if you bought a property and you had to pay £25,000 stamp duty and then £5,000 in solicitors fees and moving costs and all that sort of jazz, and someone's coming to test the circuit board to make sure any other professionals and other trades and other fees that you might have to fork out. What could you see with that just that one-off £30,000 initial investment? And this is what it came back at. So the quantities held for those individual stocks and assets. So of 30,000k back in 2023, you could have bought 108 Solanas, you could have bought almost zero point 0.4 of a Bitcoin, 140 MSTRs, and then almost 60 shares of Tesla. Okay, and then the 2024, 2025 prices, 2026 prices, etc., etc. So by the end of 2024, you would have already made over $100,000 on that investment alone, on those 4 bags. All right, split that way. If you then look at the end of 2025, so this is what we're hoping for by the end of this year, that investment will be up to 176,000 just off of the 30,000 investment. Okay, so again, this is why we're looking at these 4 key assets, because I believe that they are the fastest horses. I don't invest into the S&P 500 at all, because obviously look at the previous slides. I think it's pointless. Yes, it may be the end of your investing career when you just want safety, but you know that's not my bag, and that's not where I'm at the moment. 2026, 27, all the way out to 2033. So 10-year cycle with an initial $30,000 investment. You could see yourself with a 5,000% gain and a 1.5 million investment bag. And again, depending on how you're doing it and where you're investing it, some of that could be tax-free. So, for example, your MSTR, your Tesla, you can easily invest quite a lot of your $30,000 tax-free through a stocks and trade ISA. And this isn't even into trading where you're switching things around, doing pair trades between Tesla and MSTR. You're not even having to do that. This is just the CAGR, the compounded annual growth rate for these individual stocks and assets. All right. So again, when we're looking at this, picking the right things, picking the right allocations, picking the right stocks. Again, keep your tap dancing shoes on, because you never know what's going to happen. You don't know what's around the corner. Bitcoin might not even be here next week. You know, we had the big Bybit hack where it looks like North Korea have stolen 1.4 billion of ETH. Again, this is why I don't invest in ETH. It's an old 10-year technology. So that's why I go with Solana. Everyone's using Solana. It's got the highly daily active users. It's known as the ETH killer. Again, ETH is very old. So the exploitation alone has killed and caused huge ramifications on the crypto side of things. But again, just going back to Bitcoin, we don't know. At the moment, there's never been one successful attack on the Bitcoin network, and that's been since 2008. Doesn't mean there can't be one in the future. Yes, everyone talks about quantum computing, the potential of that one day, being able to hack the Bitcoin network. I don't see it. I think other infrastructures will be hacked first, such as basic banking PIN numbers and passwords will be hacked left, right and centre with quantum computing, not the Bitcoin. And also, don't forget, they can still upgrade the security measures on the Bitcoin nodes and whatnot. So, so that's why we look at these 4 asset categories: Solana, Bitcoin, MicroStrategy and Tesla. So where does that take us? Just to wrap this up and get to the final page, basically conclusion. So it's really important that you're in it to win it as such. Okay, so what this means is out of the entire trading year, there's probably only 9 magical major positive gain days where if you aren't invested in that in the stock market during those days, you're going to miss all the major gains. So it's important. Yes, if you can time it right and you can step back when all the major downsides happen, incredible. But not everyone has the ability to do that. So, it's more important to be in it for the long term. Timing is everything, okay? So there's a saying that billions are made in the bear. What that means is that when you are trying to pick your allocations, your asset classes, where you're going to be investing, especially when it comes to things like crypto and Bitcoin, it's imperative you try to identify when the bear is for each cycle. And why is it important to do that? Because you need to allocate hard and big when you believe the bear is in, and then you ride the 3-year cycle up, and that's how you make the most gains and most profits. Research is paramount. Obviously, you need high conviction. You need to do a lot of checks. You need to find out what you believe is the alpha or such, and you need to allocate hard to it. That's how you make the most money. and you need to be in the fastest horses. So again, finding the alpha, getting to the top 1%. There's no point investing in just wishy-washy companies that, you know, aren't well managed, aren't well run, that haven't had good profits, that have got, you know, if you invest in something that's got a ridiculously high PE ratio forecast, then, you know, there's a good chance that you're picking pennies up in front of a bulldozer. You know, you try to do your homework as such. Yeah. Follow the right people, but do your own research, do your own technical analysis, look at the charts, and that trading is a zero-sum game. What do we mean by that? Basically, whenever one person wins, someone else is losing. So especially if you're doing options and leverage, things like that. All right. That's it for this week. These are the things that I speak to my friends and my family about, boring the pants off them as usual. But I think that everyone can make more money and get richer, providing they're willing to put some time and effort into learning it. So simple as that, really. Obviously, any questions, hit the likes, hit the subscribe, put the questions in. I'll always try to answer them as quickly as I can. Anything that I think is a real good question, I'll highlight on the next video. But thanks very much for watching. I'll speak to you soon. Take care. Goodbye.